ASG Group is an Australian IT services company. We've got a national footprint and we specialise in managed services. We do project services, but latterly we have transformed ourselves to the provision of what we term New World services. New World services go beyond technology. What they're about is transforming and reforming ICT companies within client businesses. The first half 2016 results were in line with the guidance we gave at the AGM in November. Our revenue figures were 88 million, which was in line, as I say, with the AGM. Our EBITDA was running at 12.7, both operating and declared EBITDA. We had a net profit before tax of 7.6. Results were driven by a number of factors, not the least of which was the continual take-up of our New World offering and the fact that our managed services started to, for new contracts, started to actually contribute. We have a lag in our managed service revenues because we will sell and then we will do a transition, but the actual full revenue impact doesn't cut in until some months afterwards, as opposed to transactional project-related services. The value of the order book is quite substantial. We've got about $340 million worth of pipeline that we have either qualified into or in the process of finalising. We recently announced a contract extension to the value of $112 million for the Department of Education in Victoria. That will take us, if it runs its full length, to being incumbent in that account for close on 16 years at the end of that renewal. We do a lot of work recently with Clough and with CIMIC in relation to New World transformations of their businesses and their IT. Increasingly, what we're being asked to do is provide global support as well as Australian-based services. Our outlook for FY16 is exceptionally positive. As we gave indication at the H1 results, our revenue figures will be around about 185 mil to 190 mil, with a corresponding EBITDA running at a 14.4% margin. It's again, as we outlined before, a lot of that is contributed to the fact that contracts that were won in previous years are now contributing fully in this financial year. Similarly, the outlook for FY17 is even better because of the contract wins this year that will contribute in the following years. One of the biggest trends that we're seeing is that the clients are no longer interested in buying technology. Technology, as it's in its own right, has become commoditized. Technology has become very much almost passé. It's business outcomes, it's driving business value, and it's driving, certainly a return on investment, increasingly happening. What that means is that organisations, particularly vendor organisations, have to be in tune with what this change means and in turn change their business model to actually accommodate that. We made a decision some years ago to actually move to an IP-based organisational structure and an IP-based service offering. Organisations such as large multinationals, whether they be the traditional Indian body shopping organisations or the likes of IBM and, dare I say it, even Oracle and CSC and SAP, etc., with their entrenched business models, finding it very hard to change and make the adaptation. The next 12 months are probably going to be fairly challenging for the industry at large. Revenues from traditional projects will be down. ASG is well positioned, however, because of the locked-in revenue that it has through managed services and, in turn, the New World scenarios. Ideally, my personal view for the next 12 months is that we will increasingly have a push into business analytics and intelligence and exploiting that for our clients, which in turn will drive business change and in turn drive projects for ourselves and provide value to the clients.